Welcome to Multifamily Insights. I'm your host, John Casman. Listen, if this is your first time checking out this show, welcome. Be sure to hit that subscribe button so you don't miss an episode. And if you're an avid listener of the program, be sure to leave us a rating and review. Today, we've got a good one. We're going to be talking to Veena Jetti. Veena Jetti is the founding partner of Vive Funds, a unique commercial real estate firm that specializes in curating conservative opportunities for investors. Now, Veena brings a dynamic perspective to targeting, acquiring, managing, and operating assets using best practices combined with cutting-edge technology. Let's welcome to the show, Veena Jetti.
Hey, John. Thanks for having me. I'm excited to be here.
Absolutely. Veena, listen, we were joking offline. This is long overdue, so I'm excited to get you on the show. I went over your bio at a very high level. Take a couple of minutes and give us more context.
Yeah. So, you hit all the important parts. So I come from a real estate family. So I kind of took the shortcut into real estate investing. My mom is actually a successful real estate investor. My parents retired early from their portfolio. I graduated college when I was 20 with my degree in finance, thought I knew everything at that moment and decided not to go work with my mom and to go into corporate America. So I went into corporate real estate, which I'm sure drove my mom a little crazy. But ultimately I left corporate America back in 2012. I was on the management team for $1 billion asset in corporate America. And then started investing for myself and eventually continued to scale. And now we have we've transacted on over $600 million worth of multifamily assets in my portfolio.
I love it. Wow. So you went from, your parents working in multifamily or real estate, I should say, building their portfolio, really a second generation real estate investor, shunned it, said, I'm going to go away and do something completely different. And that completely different thing was corporate real estate. Yeah. But ultimately, You've been able to launch your own portfolio, grow it, and now you're up to $600 million in assets that you've done. I think that's really remarkable. What do you think you attribute that level of growth and scale to your success? What do you attribute that to?
I think it's probably two things, right? One is perseverance. I'm very persistent about everything I do. My mom always used to say, like, oh, when Veena has a bee in her bonnet, she makes sure it gets done. So I think that's one thing, because obviously there's a lot of challenges that come with this scale. And I think the second thing too is, I'm the daughter of immigrants, and my parents came here to give my sister and I, an opportunity at a better life. And I took what they gave us and I wanted to grow that to the next level and kind of fulfill my obligation to the sacrifices that they made for us. So I think both of those things maybe contributed a little bit to it. And then a little luck along the way doesn't hurt.
Little luck goes a long way if you can get that to happen. But again, you put in the work, right? You talked about having that drive really from being a child and understanding what you want to do, putting in the work, putting in the effort. Let's dig in a little bit more there, right? So Vive Funds now, you've been running this for how long? And talk to me a little bit more about the markets you invest in or the kind of assets you buy.
Yeah, so I actually launched Vive Funds in the middle of COVID.
That's fun.
Yeah, which was a different experience all in and of itself. But really, what I love about it is I am the partner that makes the decisions there. So the buck stops with me. So whether it's good or bad or indifferent, it all comes back to me. And so I really like being able to have that level of control and deciding where our assets are, what projects we go into, where our investors go. And not having, the red tape that you might need to cross in other types of structures. So that's where how Vive Funds rolled out. What was your second question to me? I already forgot.
Just understanding more about the assets that you're investing in and the markets you invest in.
Yeah. So we're very, very laser focused. So we target Class B value add multifamily assets. We won't underwrite anything under 200 units. And really, we have a preference for 300 and up. And our markets that we target as of right now are Texas, Georgia, Florida, North Carolina, South Carolina, and Arizona.
All right. Texas, Georgia, Florida, basically that Sun Belt there around the Southeast region. Texas, Georgia, Florida, the Carolinas. And what did I miss?
Arizona.
In Arizona. Okay. Arizona on the other side. Yeah. Love
Yes.
it. Makes a lot of sense, right? I mean, for those who listen to the show often, we talk about how to find the best places to invest. And we're always looking at population growth. We're looking at job growth, diversification. And these markets are doing extremely well when you talk about it. Florida, Texas, Georgia,
Absolutely.
Arizona. These markets are seeing great population growth. I want to go back though to the asset class. You mentioned
Mhm.
Class B apartments, value add deals, 200 units and up, but the preference is for 300 units and up.
Yeah.
Why that set of criteria, especially on the size?
Yeah, because really you start seeing the benefits of scale at 200 plus units. And what actually has happened is so we've actually only transacted in Atlanta in the last year and a half, which was not by design in the sense that we didn't only target Atlanta, we targeted all those states. But once you start getting to a certain amount of scale in those different cities and you get kind of that saturation, a lot of your efficiencies become pronounced. So, for example, right, your landscaping contract, landscaping on 200 or 300 units is a lot different than negotiating a landscaping contract for a 100-unit asset. When you have it now across three different assets where you have almost 1,000 doors, you get much different pricing, you get different quality, you get different attention. And so that's why really that asset class. And then also from a size perspective, typically our sweet spot is somewhere in that 70 to 100, 120 million is kind of what we're looking at in terms of cost of the asset or purchase price of the asset. And when you get to that kind of, I'd say anything above like 50, 60 million, you start having less competition from ultra aggressive capital. And so it makes it easier for us to get the right pricing on our assets. Does that make sense?
It does. I mean, ultimately, when you get to a certain price point, the types of investors who are looking at an asset like that are very limited, and they probably have similar return criteria that you have. So it's not just the doctor who's got a little bit of extra money and he's
Correct.
willing to pay a premium for this property, or somebody doing a 1031 exchange and they're willing to buy this property at a premium because it just fits their investing goals. So that makes a lot of sense. And you said that's what, 50 million and up, or what was the number you said?
We look at like 70 to 100, 120 million.
Okay, I
But
was way off. Sorry.
I mean, no, but I did say at 50 million and up, you kind of start seeing a little bit more of that. But I feel like now 50 to 70 million is becoming a little bit more saturated with but bidders on that size of asset class. So we try to kind of move a little bit up
There you go.
higher.
All right, I have a listener right now who's trying to cut this episode off because he's like, "Oh, y'all are playing in a different, stratosphere." So I want to bring it back down, right? Because part of what this is you scaled this up, and we've known each other for a few years. And I think what's remarkable for me is watching you scale, but also watching you adjust your strategy as you kind of took off. So I want to bring it back down to maybe some of the early days where you were getting into multifamily, larger multifamily, 50 units and up. And what did that process look like? Because you didn't wake up doing 70, $100 million deals. It took time to kind of scale up and to grow into this. So talk to us about those early days in the portfolio and how your philosophy and your approach has pivoted since then.
Wait, you think I didn't just wake up and decide to do a $70 million deal one day? That's exactly how that happened. No, no, you're absolutely right. Initially, we were targeting assets that were sub 20 million. And really a big piece of that was because we were raising our capital from retail investors and our network just wasn't big enough. Our track record wasn't enough for us to be able to go out and raise $30 million like we do in today's deals, right? And so for us, we needed to make sure that the capital, we were able to stack that efficiently and, get the deal closed, because who cares how big the deal is if you can't close it, right? It's a lot more expensive to not close any deal. And so that was really how we started targeting deals and how we started looking at deals. But we've always kind of stayed true to that niche of like that class B value add space. But to your point, as the market has kind of shifted and we've kind of seen compression in cap rates, we've started kind of adjusting the tenant base that we look for on our deals and the types of deals we'll go into. So, before we might have looked at an asset that has 50,000, 60,000 as an average income. And now we're looking at assets that are pretty much above $90,000 on the median income, just for that stability in the event of a downturn or a market that's pulling back a little bit.
Yeah, and I think those are some great insights, right? Because what you're saying, if I say this differently, is that while still focusing on B class assets, you're focusing in maybe more fluent locations, submarkets where that median income is in the $90,000 range. And the rationale is it can take a hit a little bit better in the market. So if the market softens, you still have a wide range of potential renters that can
Exactly.
live at this property, versus if you're playing just at that $40,000-$50,000 price point or median income, maybe that hit is more devastating to some of those families. So just something to think about as you're building your portfolio. I think it's really important to understand who the person is on the other side that's going to be using that product. It's easy for us to sit here and talk about buying apartment buildings, but at the end of the day, what we're buying are homes for these residents, right? And you have to understand who's going to live in these homes, what are the different circumstances that can impact them, and will they still be in a position to pay their rent? Can they still live there? How will their lifestyle change? And those are some of the things that you're looking to mitigate against when you're buying these kind of properties. For some folks who are thinking about this and saying, okay, well, that sounds more like buying A-class type stuff when you're getting into the $90,000 range. Just how do you define it, right? Because you hear people describe A
Yeah.
class, B class, and some of it's just all over the place. So when you say class B assets and you're talking about, your investing strategy, give us a little context to how you define it.
Yeah, and that's a good point because it's so subjective. It depends on who is talking about B class assets. Because I see assets where people are like, oh, it's a B asset. And I'm like, we might not call it a B asset. So the way we define it is historically, it's always been 80s vintage and newer. And we really look for B assets in A locations or A plus locations is probably a better way to define it. So some people will call it like a B plus asset. Depends who you ask. Even on our deals, depending on who you're talking to, someone might say B plus, A minus. But really, we're looking at a little bit of an older vintage. And what's been interesting is in post-COVID, or after we knew about COVID, I should say, since we're still kind of at the tail end, right? What
We
we've seen,
hope.
yeah, well, I know from your mouth to God's ears, I hope we're done. But no, so pretty much what we've seen in terms of pricing is pricing on like 1980s vintage is kind of shaking out the same as 90s and early 2000s vintage. So we're kind of shifting a little bit to newer vintage because, you have less problems, less deferred maintenance. It's typically a nicer asset. And there's still a lot of value add to be done. So a lot of the interiors will still be classic interiors. So when we talk about Class B, we're talking about 85, 80s, 85 at the oldest. And then we're talking about things that have amenities, but maybe don't have the luxury amenities, right? Like, so no doorman, may or may not have elevators. It's unlikely. It's probably garden style. And it's in those really nice suburbs. So it's in those A locations where tenants could theoretically go and rent something that has a $3,000-$4,000 a month rent.
Yeah. And I love your model because the thing that always strikes me, being a former marketer, is, when you think about that individual, it's the lifestyle,
Yeah.
and it's almost more lifestyle marketing as opposed to strictly increasing the rents, because now we're talking about services. This is optional, but if you want that doorman, you want that valet trash service, you want somebody to walk your dog or whatever the
Yeah.
amenity is. These are things that they can self-select, but they could have a huge implications for the bottom line. And
Absolutely.
because you're playing in this higher price point where the median income's higher, they have more disposable income to spend towards those kind of services. So I really like that strategy. I think it's super smart. And I love everything that you're saying about it. I think a lot of people should be thinking more about how to incorporate parts of this, maybe not all of it, but think about what Veena is doing in her business and think about how you might be able to incorporate some of this thinking into your own business there. What are some of the drawbacks, right? Because you're talking about newer assets. We obviously know compressing on the cap rates, meaning that, people are willing to accept lower returns for the same kind of properties, right? But what are some of the other drawbacks you're seeing from that change in your model?
Yeah, I think that our biggest challenge, right, is that we oftentimes are underwriting assets that are at that 200 unit level, and we're competing against very aggressive capital. We're maybe competing against someone who's a newer investor and hasn't been through a downturn market, right? Like, I remember what happened back in '08. I was in real estate. I was in commercial real estate at the time. I remember that very clearly. And so I think just from a investment criteria or investment philosophy, we tend to err on kind of the ultra conservative side compared to some of our colleagues in this space. And not to say that someone can have a different business plan. I mean, if you and I had the same deal we were underwriting, we'd come up with two completely different models. And that's the beauty, right? It's as much of an art as it is a science. And so I think that when we're going out and we're raising capital, one of the biggest challenges we had on the last deal we raised in 2021 was that our return projections were very conservative, and they were put out with the idea that if there's another COVID or Black Swan event, we can still sustain and we can still maintain our investment. And, of course, we're going to under promise and over deliver, but it's hard when you have investors looking at competing deals that maybe don't really understand what the difference is in a risk adjusted return. They don't understand why I'm showing, 12 to 15% IRR, and they're seeing deals that are like 32% IRR, but they're new construction in Wyoming. Like, yeah, you should get that. That seems accurate for what you need to take on that level of risk. But my deal's in like at the Atlanta suburbs. It's a 2011 construction, and it has almost no delinquency or bad debt on it. It's a different profile, risk profile. So I think that investor education maybe is the biggest challenge we face.
Yeah, great insights right there. And I think to your point, it's very tough when there's a lot of opportunities that people have. And sometimes you don't have that, but people have options. They're looking at one deal, they're looking at multiple deals. Everyone underwrites a little bit differently. You're really looking at apples and oranges. It's not really fair to look at one deal and say, oh, this one has a 17% IRR and this one only has a 14 IRR. I'm gonna do the 17 IRR deal. And I think that's a mistake that people make. Talk to us a little bit more about that, because I see that a lot, and people not necessarily adjusting for risk when looking at that return projection. So maybe you can just elaborate a little bit more.
Yeah. So what I always tell investors when they're having this exact dialogue with me is, look, these are risk adjusted returns. The higher the amount of risk you're willing to take on, the higher your return should be, because your risk of losing capital is significantly higher, the higher your return projection is. And the second thing I also like to point out is these are all projections, right? So it doesn't mean that you're going to get 17%, 20%, 30%, whatever the projection is. I can project anything out just by adjusting the inputs. It's garbage in, garbage out on underwriting. So that's easy for me to do. But what you want is you really want to understand the method behind the madness, right? So you want to understand why someone is underwriting in a certain way. And it's the same thing. Like, everybody says they're conservative. No one's going to be like, oh, I underwrote this really aggressive and I don't think we're going to hit this. Do you want to invest? Everyone's going to say they're conservative. So you want to understand how they're conservative, right? Like, when was the last time someone said they were being really aggressive on their assumptions?
Never, not a single time. And it's interesting because, I think that one of the things that is really important is understanding where and how someone is being conservative, right? Because if you're conservative in every single line item across your pro forma, you're never going to do a deal, right? If you just assume, oh, I don't want to take rents up too much, and we're just going to do this, your numbers will not work, and it's tough. And there's a balance between that. So I think the key, as you're pointing, is you want to understand the logic. There should be, what's realistic, then what's conservative based on what's realistic. And I think that's the gap that you have to understand, because if someone's crossing that and I like to say optimistic versus aggressive, because I think like you said, no one's aggressive, but there are places where you might need to be a bit optimistic, right? And I think you want to understand that as a passive investor, because there are also things that someone needs to go right in order for this to play out the way they're projecting. And you want to understand what's the likelihood of that taking place. And of course, what's backing that up? Do you have comps in the marketplace that you can point to and say, hey, look at these 3 or 4 properties, they're getting XYZ. So because of that, we feel like we could get rents that are in line with that. So you want to understand that. And to your point, I just don't think enough people understand that level of detail to make those kind of decisions, or at least understand what they're looking at when they're reviewing opportunities.
Absolutely. I mean, and I see it the most. I don't know if you see it with your investors, but I see it the most when comparing new dev to value add. And obviously your IRR has to be much higher because you're creating the value, right? You have nothing there. You have a piece of dirt there. And so there's a lot that can go wrong between acquiring the dirt and putting the building up. And, there's cost of materials, there's labor costs. I mean, there's a lot of risk at different points in development. Doesn't mean you shouldn't invest into development. It just means you should understand the risk of what you're investing into.
Well, and I think to your point, there's the whole spectrum, right? If it's new development, that's probably the riskiest type of construction deal or that you can do. There's value add, but even within value add, I mean, there's heavy repositioning, distressed asset where it's 50% occupied type thing. And then there's something that is 98% occupied, or rents are maybe 10% below market, but it doesn't really need much renovation. It's just a matter of operating and coming in and adding some of the value things that you talked about. So there's different spectrums there. And as you talk about that adjusted return, you have to understand what your comfort level is. And then, what's going to, how that operator is being conservative or what their assumptions are based on. Talking about that a little bit more, I do want to talk about the transition, because one of the things you mentioned was when you started out in the space, you were focusing more on kind of under $20 million deals, right? Deals that are under $20 million. And that's because you were focusing on retail investors, which is, anybody listening to the show, is you taking the money you have in your bank account and investing it in one of these kind of deals. It sounds to me like you've expanded kind of your capital now. So maybe you can talk a little bit more about that.
It's actually funny you say that. Someone else asked me this morning too. We actually are still a retail investor heavy.
Okay.
So we are not taking institutional capital at the moment. It doesn't mean we won't in the future. It's just for right now. Our retail capital is very strong. They repeat invest with us. What we have seen a little bit of a change in, especially in these last couple of years, is we see a lot more family offices co-investing with us. And I'll say we as sponsors, we're the largest investors in our deals. So we get one nice chunk out of the way before we even take it out to our investors. But typically we're raising from high net worth, high income professionals. Most of our database happens to be physicians. Everyone has kind of their niche, and, it happens when you have enough deals, you get referrals. So it just kind of happens that it's all heavy in one sector or another. But yeah, typically we are raising capital. Our minimum is 50,000. So still primarily retail. And I'd say our average investment is about 167,000.
Okay. So you got a lot of investors coming in doing maybe 200K or something like that on some of these deals. That's awesome to hear. And it's great to hear that you're able to raise this amount of money for these deals with retail investors. I mean, if you're doing a 70, let's just use 100 million for easy numbers, right? You're talking about $100 million deal. What are you raising on that? Maybe 30 million, or what's the raise on something like that?
Yeah, but 35, maybe 37, depending. So on our deals that have been around 80 million, we're typically raising anywhere from 25 to 29 million.
There you go. I mean, that's a huge raise, right? I mean, you're talking about being able to raise close to $30 million by pushing a button, sending this deal out to your network. So there's got to be some gaps, right? I know that, I know you make it look easy, but to raise $30 million on a deal like that, what are some things you've had to do to kind of get better with your systems and processes so you could scale?
Yeah, I mean, that's exactly it, is setting up those systems and processes. So we rinse and repeat everything we do. We also fine tune every deal we close. We go back and we fine tune, where can we make it smoother? Where can we reduce friction? How can we answer more investor questions before having to step in and interact one-on-one with an investor? So typically we're raising our capital in between our deals. So I don't wait for a deal to be on my lap in order for me to go out and raise the capital. I've pretty much raised it mostly before I have the deal. Once I have the deal, then it's just investors looking at the deal, making sure this specific deal fits their criteria or their portfolio. Other than that, they've already vetted us. They've vetted the business plan. They've already done all of their due diligence except for just the specific deal. So that's how we've had enough momentum to be able to raise that kind of capital, because a lot of our deals we're closing in 45 days or less, 42 days. So it's a lot of coordination, I will say that. Also utilizing technology. We have an investor portal. We use DocuSign a lot. It's kind of like our holy grail. We record a conference call right at the beginning so that we have that to send out to investors. And we do that live. Typically, we found a lot of success with that. We try to do like Q&As. We collect all of that ahead of time. So it's a pretty seamless process now, but we are always trying to improve.
I love it, man. Great information there and great tips on being able to grow. And a couple takeaways there was one, making sure that you're always raising, right? So you're talking to these investors before you have a deal or in between deals. That way, they're ready by the time you present something in front of them. I think a huge mistake people make is waiting until they find a deal and then presenting it. And then now you're not only answering questions about the deal, but they're trying to now learn about you, the
Yep.
market, your strategy, your experience, the team. It makes it difficult because it's overwhelming for someone to take in that much information. Even if they love the deal, they now have to make a decision on whether or not they like you, whether or not they like the market, whether or not they like your strategy, whether or not you're being aggressive, conservative, optimistic, whatever word you want to use there. And it's a
Yep.
lot to try to figure out in a very short amount of time. So the more you can do some of that legwork in advance, it just makes it easier. And having those systems and processes is really key. Because I will tell you, if you've never if you've never done a deal and you start a syndication and you realize how much paperwork is involved with the PPMs and the logistics of wiring funds from all of the investors and all of that kind of stuff, it can absolutely be overwhelming. So you definitely want to make sure you understand some of those things, set up the systems and the processes so you can be efficient and effective with your scaling. One other thing that you and I were talking about is you have been um, amazing at really growing in social media. And I've loved watching it. And I've seen you on Instagram and pretty active on Instagram, but in particular, Clubhouse. You
Yeah.
just kind of crushed the Clubhouse scene, and I've seen you do a Clubhouse live event, and really just take that to a completely different level. I saw you with Alvin Hope Johnson, who was another guest on the podcast, and we love to have an Alvin on the show. And I've watched you really just go into this environment and scale and build a platform and a voice for yourself. Talk to us more about Clubhouse, what you like about it, and should other investors be looking at leveraging Clubhouse as a platform for themselves?
Yeah. Well, thank you for all of the compliments on social media because I actually am really terrible at social media. I recently hired someone who handles all of my like posting and content creation. So that's why it's maybe looking better in like the last few months. So that's like, I can't take credit for that. But on Clubhouse, it's kind of impossible to have someone do it for you because it's a voice based app. And it's no secret, I really like to talk. So it's actually like the perfect form of social media for me. I started off on it about a year ago now. And what I really liked about it is you can connect in a way that you can't connect on other forms of social media because it's very intimate, right? You're talking to each other. It's like a live podcast that you're interacting back and forth with all these new people. And, Alvin, it's funny, Alvin and I were introduced to each other like 5, 6 years ago by a mutual friend. And we both were like, okay, this person's like not that serious, whatever. And we got reintroduced on Clubhouse. And it has just been phenomenal because now, we're partnering on different business ventures together. He's the one who throws Clubhouse Live, which is rotates in different cities. And I speak there. I go to everyone. But I do think that it is a great tool, not just if you are looking to connect with other people, but also to learn. I learn a lot of strategies from other operators, even in other spaces that I'm like, oh, I wonder if we could utilize that in our model in some way and make our model better. And so I think it's really important for people to, whether it's through Clubhouse or any other social media or in your in-person networks, but to be around people who are doing something maybe different, but who are at the top of their game. It's just the access you have to people in that are elite in their space is just unbelievable.
Yeah, it's a great platform, and it's one that always intrigues me because there's an authenticity that is there. Like you said, it's the one platform you cannot source out.
No.
You can't go get your creative assistant or your VA to come and do this thing for you.
Yeah.
It doesn't work that way. And what really helped it to grow, at least last, in 2000, late 2020, early 2021, is you were having big, huge names on this platform. Kevin Hart, Grant Cardone. You were having a lot of, folks who are pretty well known in the space, a lot of celebrities who are using this space. And it's a rare opportunity for, a random group of people to be able to interact,
Yeah.
and be able to talk. Even at a conference, you go to a big conference and someone like a Kevin Hart is on stage, if you're in the audience, you really don't get a chance to go and chat with Kevin, right? You can raise your hand and maybe they call on you and you get to ask a question.
Yeah.
But, you know, this is a platform where you really could interact. And I thought it made it really unique. On the flip side, as we were looking into it, the biggest problem was the commitment. And we were like, how much time can we actually commit to this? We've got a lot of other things we're trying to do. But I think it is a platform that, if used correctly, could be a great way to grow. So it's just one of those things you want to monitor and figure out, you know, is this something that you want to learn more about? Is it something that can help your business? And is it something that you want to go ahead and commit to? And it's worth trying it out, at least to learn more about the platform and really putting yourself out there so you can build these connections and relationships that could take your business to the next level.
Yeah, you know what I'll say too is the time commitment is unreal. Like when I first got on there, I didn't know the etiquette of Clubhouse. And so I would get stuck in these marathon rooms. I'd be on stage for like hours at a time. And I was like, oh my gosh, are we ever going to close this room? Then someone chimed me in and said, like, hey, you don't have to stay here the whole time. You can like go and do other things and come in and out. And it's not rude to just like leave somebody's stage. And I was like, oh, thank God, because I can't be on here for like 8 hours at a time. I have a business. So that's one. But then two, I think the other thing is I utilize it kind of like people listen to like podcasts or the radio, and I have it on in the background. And then when someone says something that kind of piques my interest, I'll turn my attention to it and take a break to listen to it or to answer a question or interact. So I think if you use it in that way, it can be really powerful. You know, I've raised over 7 figures off Clubhouse alone. So
Wow, well, there you go.
Yeah, it's worth the effort.
There you go. Great insights right there. And I think that's the other thing, right? Is like, who's there? You know,
Yeah.
who's the audience? And as we talk about social media and any social media, I think part of that question is, you know, are you reaching your intended audience? And Clubhouse obviously is a newer platform, so a lot of that's still been worked out. But in a similar vein as like maybe TikTok, where I'm sure there are people who are raising a ton of money on TikTok, but it's not the natural place you would go to say, hey, you know what, let me go on TikTok so I can raise $1 million for this next deal. But either way, you should definitely explore Clubhouse. And Veena, we'll make sure you put a link to your handle in your bio there. So if anybody wants to connect with you on Clubhouse, we can make that easy to do. If folks want to learn more about investing with you, vivefunds.com is the website, but they can also reach you on some of your social media platforms, correct?
Yes, I'm Veena Jetti pretty much on every social media platform. So I'm easy to find.
All right, let's jump to a round of insights.
Okay.
Give me a failure or an apparent failure that sets you up for later success.
Oh gosh, I think, okay, so COVID, right? Not COVID as a whole, but during COVID, I think that when it hit, so many of us none of us had been through a pandemic, right? And none of us knew what was going to happen. We didn't know what to do. We weren't really sure how it was going to affect multifamily. And I think that in that moment, a lot of the instinct was to just not necessarily address it head on with investors, and investors were scared too. And so it's actually a regret I have, but I've learned from that and I no longer do this. But we had waited for about 6 to 8 weeks before starting to really hit outbound marketing, especially on assets that were a little bit more concerning in terms of the tenant base maybe not being able to withstand missing a paycheck or two if they were positive for COVID. And so what I learned from that ultimately was nobody really knew what they were doing. Nobody really knew how it would affect us. And so in hindsight, I wish I would have immediately within that week that the country kind of shut down. I wish I would have started setting up regular outbound communication with investors, whether it was, setting up a monthly conference call or a monthly additional email. But I wish I would have really amplified the communication at that point, because investors deserve to, and they wanted to hear from us, even if it was just to say, we still don't know what's going to happen. We don't know how this is going to affect us. They wanted to know we were looking at it and we were paying attention to it. And it's hard sometimes because you're so busy operating your asset and trying to mitigate any damage that happens to the investment that you forget how scary it can be for investors. So I've changed that entirely in Vive. My whole business is centered around being investor focused. So it was kind of like a failure, something that I think we did wrong, that I think now we are set up to do better.
Give me a digital or mobile resource you recommend for your business.
Oh gosh. Okay. So digital. Okay. So I have recently been playing around. Do you know what Adventures in CRE is? Have you heard of the site?
I don't.
Okay, you should check it out. It is a site that will teach you how to underwrite deals of all different asset classes. And it's a pay what you can or pay what you can afford model, which I think is really cool. But their models are really great. They're very in depth. You can run like all sorts of intricate, complicated models. Like you can run like a Monte Carlo model, which is like a billion different scenarios that it'll come out with the probability of any one happening. And I'm kind of like a spreadsheet geek, so I kind of like looking at stuff like that. But I think it's a good resource for anyone starting out too, because they have video tutorials which will walk you through the process if you're trying to like start from zero.
That's cool. Definitely check that out. Give me the book you've recommended or gifted the most in the last year.
Oh, okay. So it's funny because I have been talking about this book and it's the second or third time I'm in the middle of reading it now. So it's Outliers by Malcolm Gladwell. I don't know if you've read it before. It's a great book. And I actually stray from the path in that I don't read a whole lot of like real estate specific books. I read more books on around like mindset, business skills, interpersonal skills. And so that is the book right now. It's like top of mind for me. So
Outliers, we got it here. I love this book. It's a good book. Give me a daily habit that helps you stay focused on your goals.
I actually take time out of my day every day to spend with my kids. So my kids are 2.5, so they're little still. And as busy as I get and as caught up as I can get in work, I could work from like 6 a.m. until 2 a.m. without stopping if I didn't actually take a break. So I now block on my calendar 2.5 hours in the evening after their nanny leaves for me to spend just quality time with them. I mean, of course, there's exceptions. Sometimes I have to do work, but for the most part, I try to spend that time with them, undivided attention. I try not to have my phone with me. And I try to, we eat dinner as a family. And so that for me is really important. It recharges me. It reminds me why I'm even doing what I'm doing.
Give me your number one insight for multifamily investing.
Oh, this is a good one. Okay. So I think the insight is if I could give myself advice like 10, 15 years ago, I wish I would have scaled up faster and been less afraid of making that jump. Because I know it can be intimidating to go from, 1 to 4-plex, 10-plex to 100, 200 units, but find the right partnerships, find the right mentors, find the right people to guide you through that. But I wish I would have scaled faster because once you start scaling, it's exponential growth from there.
Love it. Great insight there. Let's lighten it up now. Where are you located right now?
I'm in Dallas, Texas.
All right. Dallas, Texas. Give me the best place to grab a bite to eat in Dallas.
Oh gosh, I'm a foodie. And so it's really hard for me because I feel like Dallas doesn't have like the best restaurants. But we have a sushi place. I'm actually in Frisco, like north of Dallas. And there is a restaurant called Kai, which is like a sushi restaurant, which has really good food. They just redid their menu. So I'm happy with that. Their drink menu is great. So I think right now that's the top.
All right, Kai, it is. Listen, yes. Veena, you gave us a lot of great information. I loved how you talked about your background in scaling and the importance of scaling and why you're scaling, because it's often, something we have conversations with people and they tell you what their criteria is. But if you don't understand the logic behind their criteria, it may not help you inform your own criteria. So I think you just breaking down why you look at the kind of properties you do was very helpful for listeners. And then also really just bringing down like, yes, these are huge properties, $100 million type assets, but understanding how you got to the scale, what that trajectory looks like, and understanding that it could be attainable for you. Again, for folks who want to learn more about you, want to learn about maybe investing with you, Vive Funds is the website, VIVEFUNDS.com. Check it out. Veena, I just want to thank you again for coming on the show, being a great guest, and look forward to talking to you again soon.
Yes, thanks for having me.